my portfolio is 96% Alibaba, 4% on SE.
Okay.
So almost all in on Alibaba,
Right.
but no longer buying anymore because stand a 20 to 30% drop and won't get margin call. What's already dropped quite so much, it cannot be judged.
Can, who say cannot?
20%.
Citibank can go down 90%.
Yeah,
What? Amazon also can go down 90%.
really Alibaba,
why Amazon can?
yeah.
Why Alibaba cannot? Welcome back everybody to another episode. So today I have a special guest. So it's Master Leong. I think for some of you guys have actually missed him for many of his Alibaba related videos and podcasts that we have created on my channel. So I think before we even go into specifics and whatnot, I just want to ask, how have you been, Master Leong?
Master, I still disappointed with Alibaba because boat is still at port. Alibaba boat haven't leave port. Yeah, so feeling motivated. Hopefully the second half will be better.
Okay.
Yeah, so still enduring.
So in terms of your portfolio wise, if you are open to sharing, now in terms of the allocation, I think you are still very
I'm still super heavy on Alibaba. Now my portfolio is 96% Alibaba, 4% on SE.
Okay.
So almost all in on Alibaba, but no longer buying anymore because already so much of my portfolio already. Even I buy some more, it doesn't average down my price already. So just hold, endure, and waiting for the recovery.
And if you don't mind, in terms of your cost basis, it's around 180 to 200, right? I remember.
So for the Alibaba, right, since 2 years ago, I started buying from 240 all the way average down until 150. Also, my average cost is about 180 like that. Then because when Alibaba crashed to $60 level, I cannot margin call.
Right.
Then my average price become higher, factoring the margin call, but I'm forced to sell 1/3 of my Alibaba shares at the $60 level.
Yes.
So factoring the margin call, my average cost now is about 200 to 220 like that.
So
I got 3 different accounts.
So that's what I want to confront.
Alibaba.
I want to confront you.
Yeah, all in Alibaba margin.
No.
Don't do that. Don't do that.
Yes, I want to confront you on this idea. This whole idea of leveraging. Are you still leveraged today?
Yeah, I'm still leveraged.
Why? Why are you
I'm
doing
now
it?
1.5 times leverage.
Yes, why are you doing it?
Gambler mindset already. Because once you deleverage, right, it means you hold less shares.
Yes.
Yeah, so I cannot afford to hold less shares. And instead, I want to hold more shares so that on the uptrend, right, then I can win back my losses. Just like you are like casino mindset already.
No, I think
already,
the issue
now is to you want to fight back.
Right.
Yeah.
I think the issue is because I know you have been contributing to your portfolio, right? You have been putting in money, you have been buying new stocks like Meta, it has been a great run for you. I think the other time was up like a good 50-80%, right? Because you managed to catch the bottom. I'm thinking why because you're increasing exposure, you are constantly putting money in. You should be deleveraging, because your new funds are going into deleverage the portfolio.
So since we last talked, maybe half a year ago, or 6 months ago, so I opened a new account, which is the Weibo account. It's an advertisement. Then I contribute about, let's say, 500 to 1,000 every month.
Right.
So now the account has about 10K inside.
Okay.
Yeah. So for the 10K, right, what I did with this money, right. So firstly, I did not use the 10K to pay down my margin.
Right.
So the Tiger and Momo account is still leveraged. So I just take this fresh funds, start another account, and this account is also 1.5 times leverage.
Wait,
so,
you bought Meta and C on leverage as well?
Yeah, I also bought on leverage. Very huge.
I mean, it works when it's going up. I mean, you manage to profit from the recovery. But
because
it's not.
My thinking is that is that I can afford to lose even if I get margin caught.
I think
so
it's not really the idea of whether you can lose or not. I think it's more of portfolio allocation, and it's not a conventional way.
Yeah, not a conventional way. Very aggressive.
It's too aggressive.
Like people, there's like aggressive, conservative, but mine is aggressive, hyper aggressive. Right? But not only am I 100% vested in equities, right? I'm also very focused. Like the 10K Weibo account, right? I only put into 3 stocks.
Right.
So what I did for the past 6 months, right, was every month I will DCA into Baba, Meta, and Google. That was the second half of last year.
Okay.
So what's Baba definitely because it's undervalued. So why I split half the money also into the Meta and Google, because there was the tech sell down. Or the US big tech was sold down. I felt that Meta and Google was also undervalued because they were trading. Like Google, Alphabet was like below 20 times earnings. Then like Meta, right, like I mentioned before to the audience, right, is that it's still a major cash cow. The family of apps still generate a lot of cash that people are very negative of the metaverse. But the metaverse business you're getting for free is like a free lottery ticket. So all these 3 companies in the second half of last year was undervalued. So I spread all my DCA into these 3 companies. Then on 1.5 times.
So the funny thing is, Alibaba, even despite holding it for so long, I think 2-3 years, got 2 years plus now, right?
2 years plus already,
right?
I think going 2.5 years already.
Still haven't come back yet.
Yes,
While the others that you've been invested all went up, and I think you all took profits on them, right?
So I hold the Meta and Alphabet probably just like less than half a year only.
Correct.
Then Meta went up 40%, I took profits. Then Alphabet, I took 20% profit. So once I sold them and take the profits, right, I'm thinking, wow, Alibaba boat still at port. So
then
I took the Meta and
then you bought more Alibaba.
I need to buy more Alibaba.
Then I think I wanted to go back down to the question. Even as a fellow Baba bull, right, I think you are very aggressive, and really the leverage is I don't recommend people, even though I was in slight leverage because I was selling puts. But anyway, I think circling back to this idea on Baba, right, have been underperforming for so long. Have your conviction ever been shaken? Despite the market keep coming back and punching you in the face saying, you're wrong, you don't, the stock is not going to come back. Or so many some of the growth stocks, even some of this big tech, it went down and then it went up the cycle again. 2 years plus. Have you went back and think about your conviction?
Now my conviction is stronger. The lowest point was actually when Alibaba was $60.
Yes.
The other time when we spoke, then my paper loss was more than 200,000. Then that one, because I cannot force sell 1/3 of my portfolio, then it's like $60 already. Then you will think like, if it goes to 40, 30, will I be liquidated? Everything will be gone. Will Alibaba even go to 0?
Right.
Then it's like the Russia stock exchange like that. Everything is become worthless.
No,
but in the
Russia
end,
still not bad. Russia index is still okay.
In the end, it didn't happen. Then Alibaba now, although this year it tests $80 level 3 times, and forming a triple bottom. Then I still feel that fundamentals, it hasn't really changed. And in fact, my conviction grew stronger because they announced that they will be doing the split into 6 units. So last time when I spoke with you, like you asked me how I derive the value of Alibaba. So I told you that Alibaba is the market leader in e-commerce. Then they also have logistics, they have their payment, and they also have the Asia business. So for Alibaba, right, it's worth more if you do the sum of the parts of the entire company. Now, finally that they are splitting it, right, we can realize the sum of the parts value once they split off. So my conviction is stronger because I hope that in the next few years,
okay.
Actually, I can get the value.
We can continue on this, building on this topic of talking about Alibaba because we have a lot to share, right? Like there is a lot of developments recently. I think even Jack Ma suddenly came back and restructuring and blah, blah, blah. But I think go back to the fundamentals of investing because all of us have a philosophy, right? Have you doubted the way you look at stocks, or have you doubted your way of investing? Is it correct or is it wrong and stuff like that?
For me, because I'm a value investor. I've been value investing since 2008, the global financial crisis. So in the beginning, I lost money, but now throughout the market cycles, I always believe that value investing works. You just buy great companies, they are undervalued. But just that, like short term, the market is a voting machine. But the short term seems very long. Until now, Alibaba is
2 years plus is still short term.
Still uninvestable. But I believe the long term, like 5 year, 10 year, right, definitely all the value will be unlocked. So I have to remain patient. Also, for me, I believe that value investing works. So pre-Alibaba, so before I invest in Alibaba, right, based on my 12-year track record, right, I managed to compound my portfolio at more than 20% average annual returns. But then after being hit by Alibaba, right, I so depressed, so shocked. I never tracked my portfolio, everything already, because my returns are totally screwed already, because my portfolio was wrecked very heavily. But I believe that value investing works. It's actually very simple. Buy great companies that are undervalued and hold for long term. So my conviction is still that I'm still using the same method.
But I only can say one thing. A lot of people, I got this kind of comments below, right, and one few of my videos talking about like, we talk about long term, right? Maybe yes, we agree that 2 years might not be long enough. Like it's a very short time frame. But then when you really go back to when Alibaba just IPO'd, right, in the US exchange, I think it's a good 7-8 years, right? And the stock just traded sideways. So I think 7-8 years is a long enough time frame to look at Alibaba, but it's like it IPO at 60, 70. Now you go back.
Imagine you bought the IPO, then you hold until now, then you never make money. 8 years for Alibaba.
Correct. So then, where's the idea of value investing?
That's why valuation is very important. When Alibaba IPO, right, I was there. I looked at the stock. I decided not to buy Alibaba because when it IPO, right, it was trading at 50 times earnings. So back then, when it IPO in I think 2010 or 2020 or 2013 or 14, right? So there was a lot of hype. The story was the dragon that it will be growing, because China was like going to ramp up from low-end manufacturing. It went from mid-end to high-end manufacturing. the GDP was growing at 8%. So for Alibaba, its revenues were growing at 40-50% annually. So the Alibaba back then was like the Tesla, the Nvidia we are seeing today. People will pay 50 times earnings. People will pay 20 times sales for a company that is growing very rapidly.
They're paying 200 times sales now.
They're paying
20 times is a waste of time.
It's
amateur. 200 times sales.
So Alibaba was bidded to very high valuations, 50 times earnings. That's why I wouldn't buy, despite it going 40-50%.
Okay.
So because although it was trading at $90 when it first day of trading, but it was only earnings like $1.50 per share only. But now, today, Alibaba is making like $9 per share, and the next work year probably they'll make like $10 per share. So earnings have gone up 5-fold. But the problem is the PE compressed from 50 times earnings, now is like 10 times earnings.
Correct.
And not only that, because last time when they IPO, right, it's mostly the Taobao, Tianmao, the core e-commerce business. But now, right, internally they bring a lot of small business.
I get where you're coming from.
So now,
inside. So now PE compressed.
Yeah.
I think the other time, in order for you to make money, right, you need to kind of spot where the market is wrong, right?
Yeah.
And then the market need to correct itself.
Yes.
So now on the first half, we agree, as in we are in agreement that the market is currently mispricing this business.
Yeah.
What makes you think, or what's the trigger that you think that the market will correct itself? Why is 10 times PE not fair? Like I'm just saying now as a business, right?
So obviously we know that 10 times PE, right, it's very rare that you see a blue chip company that is very representative of the economy that is so cheap. For example, like Singapore market, you seldom see blue chip trading at 10 times earnings. The US market, you also seldom see blue chip. So usually blue chip will trade at 20 times earnings for, let's say, your base earnings yield is like 5%. Then
but
usually,
who come up with this 5%?
So usually like the index, right? Let's say you buy an index, let's say you buy the US index, you are betting on the whole economy, that the companies will generate you profit and the company will grow. Like based on its GDP, it will grow. So the same thing. So we don't say Alibaba, like the whole China index, right? The PE is very low, yet the growth rate is very high. So because people think that it's uninvestable. But eventually I think it will correct when people think that it's investable. Or because now there's a lot of option. Or they instead of investing in China, right, they invest in Japan, Korea, India, and Vietnam. Or because the funds are shifting away. But eventually, let's say China, right, proves that it has the fundamentals. Like the GDP is growing now at 5%. So as China continues to grow, right, and let's say the next 5 or 10 years later, it becomes the world #1 GDP. Then and also not in terms of GDP lah. Let's say like it's technology advanced. Like say in EV, green energy, AI. Then once people see that, it's very clear. China is the leader, both in technology and in GDP. People will naturally put a portion of their portfolio in the world leader.
Okay, I hear
for
where you are.
Portfolio allocation to shift, right, China needs to do more to prove itself.
Okay, I do agree. So there is this idea of mean reversion, right? At the end of the day, it's all still mean reverting.
Yeah.
Japan had their own index going, lost 3 decades actually.
Lost decades.
And then now they are breaking all-time highs because of buffer. Whether is it because of buffer or not, doesn't matter. But there is always this idea in indexing or in investing that the idea of mean reversion. There is a standard benchmark or standard way that companies will trade. And in this case, you think that you deem that 18 to 20 times earnings is standardized for blue chip companies.
Yeah.
But then one new narrative that comes out recently. So they were saying that China, what if China goes into a lost decade? Meaning it's not abnormal, right? So Japan has went through a 3-year lost decade. You bought in at the highest peak and then you wait for 30 years. Even if you DCA, yes, you get a okay return. I mean, if you keep continuously DCAing down, then 30 years later you break even. But then when you contrast it to other major indexes or major economies, right, then you come into this entire discussion about an opportunity cost again. So are you not afraid of, or have you not went into the consideration that, maybe China, maybe they'll be slow for the next coming decade and I want to reallocate my capital again and stuff like that?
So like now, right, it could feel like it's going to be a repeat of Japan. So like 1 decade,
Population
2 decade,
crisis,
or 3
all this kind of
decade.
thing,
Yeah.
right.
Then the stock market goes sideways. Then the economy also no growth. Yeah. So when that happens, right, let's say you think of your portfolio, how can you generate return from your portfolio? Number 1 is capital gains. Number 2 is dividends.
Right.
Yeah, so let's say there's no capital gains for 10 years. The stock price of Alibaba remain at $80 for 10 years. So as an investor, what do? So you just collect the dividends. But now sadly, now Alibaba is not paying a dividend. Let's say you're holding a blue chip company like DBS. You buy at $30, then DBS goes sideways for 10 years. Then every year you get 5% dividend, or that's your base return. But for Alibaba now, right, instead of paying cash dividend, they will pay share dividend, which is like they'll give Ali Cloud.
But they can't give it perpetually, ma. They only give out one trade and mail or what.
So now they got the 6 different units, right? So hopefully, over the next 5-6 years, you get dividends of these companies. So that's my base returns. So at worst case, they give you Ali Cloud, you take the Ali Cloud share, and you sell, you still get some cash. So even if they don't do that, right, they might even consider giving out cash dividend. So cash dividend is first they must list in the Hong Kong, because now in the US, if they give dividend, they are subjected to the 30% tax. So once they get primary listing in the Hong Kong, which is maybe end of this year or next year, right, then they can give cash dividend, because they have like 55 billion in their balance sheet. So Alibaba easily, their earnings per share $8-9, they can pay $2-3 cash dividend. So that's a dividend yield of 2-3%. But that's not say very attractive lah. But that will be the base return. So but that will be very bad if it goes sideways. So like in the stock market, there's no 包价, no sure win one. There's always a risk. There's a risk that your company could be a value trap. Value trap means it's undervalued, but perpetually forever undervalued. Yeah. So will this happen? Yes, there's a risk, but I think there's a low probability lah. Eventually, right? People will see that China, the fundamentals is real. Whereas like Western countries like US and Europe, the economy is like paper economy. They keep printing a lot of money. Yeah.
But on that note, if really it's paper economy, I mean, it will just inflate, right? So the stock market will also inflate together. Right?
Yeah.
So it's not that bad to kind of hold US companies with high valuations.
So one thing, right? One thing is in the stock market, you can hold US stocks, and the US market can be up 20%. But let's say you are a foreign investor, let's say you are in Singapore, your US market can be up 20%, but you don't make any money because your Sing dollar actually strengthened against the US dollar. So example, Sing dollar to US dollar, right? 10 years ago was one US dollar can exchange for 1.8 Sing dollar, but now one US dollar can only exchange for 1.35 Sing dollar. So what if, let's say in the next 5 to 10 years, one US dollar become one Sing dollar? So you're actually, US dollar depreciate, then your spending power as a Singaporean, you actually go down, because US is printing too much money. And now that people don't feel the urgency, because they feel that US dollar is still very strong. But over time, eventually, I believe the US dollar will become toilet paper. Yeah.
But I think even Hong Kong dollars and renminbi has not been performing. I mean, SGD is a very special class of currency. Yeah. It's our national tool. So I think regardless of where you invest your money, especially if it's not in Singapore, it will lose value over time, because Singapore SGD will keep strengthening, right? Because that's our way to combat inflation, to combat all these things. But I think circling back, right, to your own investing strategy and whatnot, honestly, right, as in now, just touch your heart, have you been scarred, or have you been scared of like investing in China stocks, or have you regretted your decision in going into many of these Chinese names?
For me, definitely got regrets. Cannot be no regret. Was on hindsight, definitely if I can, right, I won't put 100% into China market. Right. I think my biggest regret is to all in on the China market, because I'm from Singapore. Before I went to Alibaba, my portfolio was actually 3 stocks, which is DBS, HRNet and PropNext.
All Singapore.
So all Singapore one. So basically, I sold DBS, buy Alibaba, Alibaba dropped, then I sold PropNext, buy Alibaba, Alibaba dropped, then I sold HRNet. So I fired 3 bullets on Alibaba. 240 whack, 200 whack, 150 whack, then until I know bullet already. So on hindsight, right, maybe I shouldn't go 100% on China. How I should keep half my portfolio locally, which I'm now in Singapore. But my spending currency is also in the SGD. Right. SGD, like you say, even if last decade, right, companies that I held, like say like DBS, HRNet, PropNext, the dividend yield was quite high. Right. So based on my cost, right, my dividend yield was like 6 to 8%. Yeah, but if based on market price, DBS is still 5% dividend yield, PropNext is still 6-7% dividend yield. So what I learned from this mistake is that market can be sideways for a long time. So dividend matters. Don't purely go for capital gains. So like maybe I'm too aggressive chasing for growth. On the balance, I think like portfolio it's good to have some dividend stocks also. Yeah, that not only like a mix of growth and dividend to balance out like the stretch that you go sideways. Yeah, this is the lesson I learned. So my regret is like
allocation.
Allocation. I could have allocated better. Yeah. But I learned from this mistake because no one is perfect. So every time investing, one thing the most important I learned is that don't be afraid to make mistakes. So some new investors, they are very afraid. Wow, they invest, then they lose money, they get angry, they upset. But every time you lose, it's like you are riding a bicycle. You have to fall down. Cannot be one time you ride a bicycle, you never fall down, and you are a world champion
Even
already.
now, I
you have
also
to
recommend against paying down your leverage. If you got now, if how do I put it? Even if you don't want to reduce the leverage, right? If you have additional cash coming in, right, you should start moving the leverage down. You get what I mean? 1.5 times is too much.
1.5 times, I can stand a 20 to 30% drop and won't get margin call. What's already dropped, crash so much, it cannot be crashed.
Who say cannot?
20%.
Citibank can go down 90%. Amazon also can go down 90%.
Really Alibaba,
why Amazon can? Why Alibaba cannot?
So boss, my mindset now is Alibaba, right? I already write my portfolio at zero already. So anything I earn is profit already. So mentally I already write off my 300,000
But that's
already.
that's
not the right
practice.
approach to invest.
Yes.
My investment approach is more like an entrepreneur. But then one thing is that why I can invest like that is also due to
your own circumstances.
everyone the situation is different. So I don't have any long-term liability. So even if my entire portfolio wipe out, right, my lifestyle is still the same.
Understand.
I still collect my rental, then I just every morning come this West Coast Park, then hiking, then afternoon look at the stock market, then at night do my live stream. So my lifestyle won't change. Then for my stock portfolio, it's like more like I'm chasing a high score. But yes, the way I chase is looks like very like a horror show like that.
It's unhealthy.
Very aggressive, extremely aggressive.
Okay. So now I think generally this is ML, right? Like his own investment journey. So I think, of course, when we invite you on, we cannot not talk about Alibaba, right? So maybe for those people, because I haven't been uploading recently, or not as frequent, right? What are the three main takeaways or three main things, developments around Baba that you think most investors should know? Just three.
Now
just
the
main.
most important thing is Ali Cloud already, because they make a very big decision. The Zhang Yong or Daniel, the CEO of Ali, he stepped down and become the CEO of Ali Cloud. So he made a statement before that he believes the value of Ali Cloud in the future will be bigger than Taobao and Tianmao. And I believe what he said is very true. You look at Amazon, they start as selling online, they sell books, then they sell everything. So it started as an e-commerce player, but now look at AWS, Amazon Web Service, is actually the crown jewel, the one that is bringing all the cash flow for Amazon, because they are the market leader. Like Amazon and Microsoft together, they form 50% of the global cloud market. So Alibaba now is number 4, forming just 4%. So although they are the number 4 player, it doesn't mean they are weak. It means that they have the potential to grow to become a top 3. Although Alibaba, they won't grow in the US, but there's Europe, there's Asia, there's Africa, there's Latin America. The rest of the world, Ali Cloud can grow. And now they will be growing aggressively. The past 2-3 years, the numbers are very weak because they actually lost their number 1 client, which is the ByteDance. ByteDance moved out of Ali Cloud and went into Oracle. But now Ali Cloud will be on growth mode. I believe that they can easily grow their revenues 20-30% in the next work year and ahead. Why? Because they are now using a pricing strategy. They lower their price by 40-50%. So instead of being profitable, they want to go for the land grab, which capture market share. Then for Zhang Yong, he's very strong at execution. That's why he left the Alibaba HQ and now focus on Ali Cloud. So he will lead the team. So the way I describe Alibaba, right, is like romance of the Three Kingdoms. So the emperor is the Jack Ma. Then all this, the Sipa Lohan is like his general. Then the Zhang Yong is like Zhao Yun, the most fearful and the most strongest warrior that can execute well and really grow the company. So Ali Cloud, right, they will give us the shares maybe, and next year we will get the Ali Cloud shares. So my tips is that this one long term really got a lot of potential. And what the most important update is that they will bring in strategic investor. Strategic investor means they haven't announced who. Most likely is the state-owned enterprises. Example, China Mobile, China Telco, or those that have links to the government one. Those listed companies that are linked to the government, so it will help them expand also. So there will be more partnership. Because in the past, right, like if we look at the cloud segment, right, each of them, they attack different market. Like Alibaba is more on the SME, Tencent is more on the large enterprises, Huawei is more on the SME. Then now we see the rise of China Mobile, China Telco also going into the cloud market. So I think it's better to partner them than to compete against them. Then this is the first number 1 news is the Ali Cloud. Number 2 is the Taobao Tianmao, right? They actually now they are for Alibaba they will become a holding company. So the CEO, right, is with Eddie Wu. Then the chairman will be Joseph Tsai. So both of them, right, have very strong investing experience. Eddie Wu, right, he actually runs a private VC. So they have the capabilities to invest in startup. Then Joseph Tsai used to be in the investment banking industry. He left his $1 million salary job to join Alibaba as a startup, and now he's a billionaire. So once Alibaba grew and became very big, right, he actually stepped down from a position and he moved to US. And he sold half of his Alibaba shares to do investment in the US, like property. Then he buys some sports teams like baseball, basketball. And he also has his own startup fund, which he invests in like crypto, high growth tech. So both Eddie and both Joseph Tsai, they are very experienced investors. So Alibaba will become a holding company and they will manage the capital. So Alibaba is basically the Berkshire Hathaway of China. But then instead of investing in traditional companies like insurance, consumer products, and railways and energy, right, Alibaba is all focused on technology, like payment, e-commerce, cloud. So you must think of Alibaba, right, as a very different company as last time already. Now it's actually the Berkshire. How are they going to unlock value? So either give dividend or give shares, or are they going to, once they have 55 billion in cash, they can do a lot of things. They can do acquisition, they can invest in startups, they can pay dividend, or do share buyback, many choices. But I believe they will make the right decision because they are so experienced to deliver the highest shareholder return. Then number three is the most important update is the 6 plus N. Then how, like they mentioned, AliCloud, the IPO probably in the coming 1 year. Then there's also the Mei and the Fresh Hippo and the Cainiao subsequently. Yeah, so all of them, they will be led by the different founders. And for all these units, right, they have an incentive to grow the company. All these companies, right, they are not dying companies. They are actually young companies, right? They are like a small chicken can grow into a phoenix or go into a dragon one. Because for them, right, they are in a fast-growing industry. For example, logistics. China logistics, the revenue growth is 30% per year because less people are shopping in the shopping mall. More people are ordering or buying from online. So logistics is definitely something that we need. Then because they will be a listed company, right, all these founders, right, they will have share options. They have an incentive. Example, if they can hit a KPI, key performance index of revenue growth 30%, stock price increasing also, so they will get benefit. They will get shares of the Cainiao. So if I'm leading Cainiao, I'm the CEO, so then I execute what I get rewarded.
So it seems like you are fairly optimistic about the breakup, right? So the market was optimistic for a while, and then it came down, crashing down again, right?
Yeah.
I think I just wanted to get your general sensing on, you think this is a net positive or net beneficial to shareholders?
Fundamentally, it's very, very good. Because like I say, I keep mentioning it, Alibaba, the sum of parts value easily $200 or $300 USD. But now the market only value it at 80 USD because it only looks at the earnings and the cash flow. As the cash flow is 25 billion per year. The 25 billion is from the Taobao and Tianmao. It's just the one business only. The other 5 businesses, because they are fast growing, they don't really generate any cash. So it's not factored into the current Alibaba stock price. But once they IPO and they spin out, right, then people can assess it individually, and then you can extract the value. So long term, yes, there is value unlocked. There is fundamentals, but short term, right, people are turning negative because the China market is not doing well. Right. Like the actually, manufacturing industry is not doing well. I want to talk
about the China market. I think maybe this is my last question for you, right?
Yeah.
So there's recently a lot of narrative building. So China is going to go into the lost decade because there's a population crisis.
Yeah.
The economy is bad. Manufacturing, everybody, exports all going down. And then everybody all shifting away. So our factories, whatever, everything is shifting out of China. Then there is this idea of decoupling and moving to India, moving to Vietnam. Like, what's your take on this whole thing? Because it really does seem like it's like, you know, the Japan boom the other time, and then they went down for the last 30 years.
So it looks similar, but now it's different. But you must really go down and understand the fundamentals. Yes, the US, let's say, take for example Apple. They used to like produce 100% in China. Now they're going to do 80% in China. 20% of their production will be India and Vietnam. So manufacturing is the one that is facing a downturn. For China now, it's called a K-shaped recovery. Some sector like manufacturing is a down leg because companies, they are moving out. So the manufacturers, they get less order, like Foxconn, they are getting less orders to do the iPhone because it shifted to India.
Right.
But other industries, example, retail is still going well. You see that the
Not as
618
expected
event.
though.
Yeah, 618, the GMV actually grew by 14.8% based on third-party numbers.
Okay.
So that they will rely more on the domestic consumption. Then traveling is back. Let's say Cathay Pacific. Now the stock price is rebounding, like up 50%. Traveling, they're generating cash flow. You will see a lot of China tourists in like Singapore, Thailand, Indonesia. So is China economy very bad? No, because people are still spending money. They are going overseas and they are spending a lot of money.
But they're not spending inside.
Yeah, they're not spending inside. Well, inside, right, because people that got money, they want to go over, but they're trapped in their own country for 2 years already. They want to see the outside world, so they travel outside. So those that are trapped inside are the common folks or the low income. Low income one, they are very cost cautious. That's why they don't have as much spending power. So they are still very price sensitive. So for Alibaba, their direction, right, is they support the SME. That means like OEM products. Whereas the branded goods, they give less support. So then we talk about the economy. So but for Chinese, right, they are very good business sense. They will not stand there, sit still and let competition eat them up. So these Chinese manufacturers, right, basically they have built an entire chain supply in China. So if you come and produce in China, your cost is the lowest. Of course, you buy the spare parts to build a car or to build a laptop, it's the cheapest and you get it the fastest. And you ship it out to the US is also the cheapest. But now that they're going to do it in India and Vietnam, so a lot of these chain supply providers, right, they actually invest in Vietnam and India. Of course, they cannot have 100% stake. But because all these Chinese suppliers, they have the know-how, they have the expertise. So, for example, they expand in Vietnam, right? They go to the industrial park, they set up factory, they partner with the local. So they each take 50% stake. And these Chinese companies, they provide the cash. Then the partner locally, they just provide the manpower. So although the whole world is diversing out of China, but China has investment in everywhere, in India, in Vietnam, and also now they're investing heavily in Africa. So don't be surprised, like now you look at Vietnam is rising, right? Then Vietnam is looking more like a proper city instead of a village. Then gone are the days you watch documentary that Africa or all the very skinny folks, those kids starving, right? Gone already. 5 years, 10 years later, you look at Africa, it might even look like Singapore. It will be modern and developed. Because now Africa, right, they're pumping billions of money. They build like a high-speed railway, ports, infrastructure, power plants. Then,
I feel like there's still a lot of friction though, in terms of corruption and stuff.
Western media will paint it as like China debt trap Africa.
Debt trap,
but then, like my audience, I do my live stream. I have audience. His name is Anderson.
Okay.
He is Ang Mo, but he is in Africa and he's working under a Chinese company. So he's on the ground. This is what he tell me. The improvement is very, very fast, very rapid. But yes, there will always be corruption. Example of corruption. Now in China, right, there are 500,000 Africans in China studying in China university, even the top universities like Tsinghua, Peita. So they give the Africans all this is a free scholarship, free education. But how to select these 500,000 Africans? Definitely have connection one, right?
Meritocracy.
It's either it's from wealthy family or is the police officer the son, or is the son of this this manufacturing that
I think we can't run away from this idea, this whole system. But I think I get where you're coming from. I hear you. So at the end of the day, I think for Baba investors, a lot of people, for Baba back holders, there are a lot of us that are watching my channel, watching your channel, right? Yeah. Do you have any parting words or last thoughts to them that are still
It's endure. So the thing is, the funny thing about life, right? The moment, if once you sell, right, it will go up already. Yeah, so you already hold for 2 years already. Imagine right now, you sell out at $80. Then they make an announcement that Alibaba IPO, then it goes up to 150.
Trade sideways for 10 years. Some people can argue that and it doesn't move.
For me, right, you must look at two things, upside and downside. The downside now is limited already. So the worst case is like last year like that. SJP got power, risk of Taiwan invasion, Alibaba crashed to 60. So how can Alibaba crash to $60 or lower? Taiwan invasion. But what's the probability? 1% or less. If that happens, then you write off your Alibaba investment. You must prepare. No investment is risk-free. You have a risk. The risk is Taiwan invasion. Your investment is gone because China invades Taiwan, the whole world sanction China, whatever. So that's your worst case. So worst case, your investment is gone. But what's your upside? Your upside is given a high probability. Alibaba, the management is trying their best to unlock value for us already. Like the spin-off or all. So to realize the value of like $200 or $300 fair value, right? Or it might take a few years. There is a probability that you won't get there. But the upside and downside you can lose $80. Upside, it can become $200, $300. So be patient. I am very convinced that the upside is there. The upside is not there. Why would I put 96% of my portfolio in the... oh yeah, technically 150. Yeah, so at the end of the day, like you saw the Charlie Munger at the AGM, people ask him, why would, for a person, right, if you see such a great company that's so undervalued, you will put 100%, you buy 100% of the business. But if you can, you might even consider 150 or even 200%. So, but that thinking is like already like 走火入魔 already. But it's like very like yeah, that is very extreme thinking. But because of this extreme thinking, right, that's why you have people like Charlie Munger. He's a billionaire. Why is a billionaire? Because he will put 100 or even 150% of portfolio into Costco. So he bought Costco and he made many times his money. And he made few hundred million. Then his whole portfolio only 3 stocks. Charlie Munger got Costco, Lidu Fund, and Berkshire Hathaway. He only hold 3 stocks, but he's a billionaire. Master only hold 2 stocks, but I'm a poor man, stay HDB. So yes, focus fire, right? You can billionaire or you can be sleeping on the streets. So, but most people should not make this choice. Or most people, they want stability, then it's okay. If you cannot sleep well, right, you worry about, wow, tomorrow SJP will press the button, invade Taiwan, and you lose your Alibaba position, then you trim down your position. Then maybe your portfolio just 5-10% in Alibaba is okay. Trim your position so that your Alibaba exposure still lets you sleep well. But if your Alibaba exposure let you not sleeping well, you cannot sleep. Like at 4 AM you wake up, you have to check the US market. 4 AM you see Alibaba, wow, down 2%, then you cannot sleep. Or then you must trim your position already. For me, right, Alibaba that time crashed to like $60, and now I still sleep as normal. Because I've been in the market 15 years already. I know what I'm doing. I know that I can lose my portfolio, but I will not keep thinking about it. Yeah, because so-called like professional gambler. So example, if you never gamble before, or not that I say investing is gambling, but it's the mindset. Let's say you first time go casino, you put $100, you lose, you feel the heart pain. But you see people like say, people can put $1 million, play baccarat, lose no feeling at all. Because they have the experience that they've been through a lot. Just like, let's say Elon Musk, he purchased Twitter, he paid 44 billion. If a common folk, you got 44 billion, you will buy Twitter. Of course, you take 44 billion, you put the money in fixed deposit, you collect the interest. Yeah, so different people, different mindset.
Risk profile.
Only take the risk that you can afford. Like let's say, example, recently there's the news, the mini submarine got billionaire, go and dive down and see Titanic. Yes. So everybody criticized, what stupid, you billionaire, you still take this kind of risk, go underground, and now you sink with the Titanic. So people don't understand, because different people got different risk appetite. Because they are a billionaire, they have enjoyed everything already. I take a roller coaster ride, I no kick. I go skydiving, no kick. I take $1 billion, buy one jet plane, the fastest plane, and fly 10 times, also no kick. That's why I want to see Titanic. And I die with Titanic, I have no regrets. Because before they do it right, they didn't know already that they have this risk. So everybody, the risk appetite is different. But some people, right, I ask you go and take roller coaster ride, I pay you $50, you also don't want to take. Because you know you take, you will vomit. Yeah, but some people, right, wow, you give me free one, I will take the roller coaster ride. So Alibaba is a roller coaster ride for sure. Not everybody is suited to take the Baba ride. Yeah, but hopefully, my view is Baba ride it's a very rocky boat but eventually you will go to Treasure Island. So hopefully you will get there to the moon.
Yes. I think I just wanted to I mean, of course, everybody have their own reasons that are currently still in the stock. Personally, I have mine too. It might differ with what ML is doing. Our different position, allocation and stuff, I'm definitely not 150%. In fact, I think it dropped down until so low that I think it's below 50% allocation now. But anyway, hope you guys enjoyed the discussion, and do follow him. I'll leave the link to his YouTube channel. I think he does live streams every night. So for those of you who are interested in different topics as well, yeah, you can check out Master Leong on his own channel. So yeah, with that, we'll see you in the next video. More importantly, we'll see you on the moon.
See you on the moon. Bye-bye.
Goodbye.